to summarize what the Fed's decision was, and then I'll hand it over to you for some questions. And so I have the normal Q&A that we always have after these meetings. And obviously between the two, I'll summon Teddy, my dog, up, and we'll feed him some treats. That's always a nice break while people think of some questions for the kind of Q&A afterwards. So let me start off with the overall decision. So no surprises here. The market was expecting that the Fed was going to cut. That's exactly what happened. And it wasn't a unanimous vote. It was 9-3. So there was some dissent in the committee, but you'd kind of expect that at this point in the rate cycle, when we're approaching the point at which rate cuts are going to end. You'd expect there'd be more dissent. When it's absolutely clear there's really high inflation, then everyone agrees that you should raise interest rates. When it's really clear that the economy's in trouble, everyone wants to cut. But now we're at the end of this cycle. Yeah, of course there's going to be dissent. So I wouldn't read too much into that. There was a lot of good discussion, according to Powell, about this decision. Anyway, we've moved now from, it was a 25 basis point cut, so 0.25%. So the new target range is 3.5 to 3.75. And that's exactly what markets expected. And it's very unusual for the Fed to do something which the market doesn't expect. And this was no exception. So why is it that there was a kind of question about what the Fed was going to do this time? It wasn't a done deal. And that's because the two different goals of the Fed, the two different mandates, which is full employment and stable prices, are pulling in opposite directions right now. It looks like the labour market is weakening and unemployment is rising, and there's risk of upside there of higher unemployment, which of course signals a weakening economy. And at the same time, inflation remains a bit sticky. So those two would tend to push policy in opposite directions. So really it's a matter of working out what the balance of risks is. And clearly what the Fed's more worried about is rising unemployment than rising inflation. So that was why they chose to cut this time around. Now, some people were saying previously that perhaps they'd wait until January for the rate cut, but that wasn't the case. They did it now. Now, according to Powell, the policy rate is now within the kind of broad range of estimates of what neutral is. So that's a level of interest rate which neither stimulates or restricts economic growth. So you could say that we're already at the end of the cycle. And in a moment, we'll look at the forecast from the market about what is going to happen to rates. And you'll see that that's pretty much what the market's thinking as well. But there is this kind of dual mandate tension at the moment, which is pretty unusual. Powell said that he hadn't witnessed it before during his tenure as Fed chair. So let's have a think about inflation. At the moment, the Fed's describing it as somewhat elevated, particularly in the goods sector. And Powell repeatedly said that this was largely because of the tariffs that we're seeing right now. Now, it was almost impossible to predict what the effect on inflation would be in terms of the stickiness of inflation. But at least for now, it's looking like it's not going to be more than a one-time shift in prices. Because if prices jump in one step with a tariff, then what you'd expect is once that jump in prices rolls out of the 12-month comparison window, which is what inflation is, it's a year-on-year change, then you'd expect no further effects of inflation unless it becomes embedded in people's psychology and company psychology, and it becomes self-perpetuating. But that doesn't look like it's what's happened so far. So services inflation is actually showing disinflation with slowing price growth, which is obviously pushing in the opposite direction to what's happening in goods right now. And certainly if you look at the summary of economic projections, and again, we got an update of that, which we'll look at in a moment, the median participant expects PCE inflation is going to be at around 2.9% for 2025, and that's going to fall to 2.4 in 2026. So pretty much moving towards the target, such as only 40 basis points away from target by the end of next year. Now, the worrying thing, of course, was the labour market. So we're still at very low levels of unemployment in the United States compared to history, but it has started edging up. Now, if you look at US unemployment, it's actually a very good predictor of US recession. And you've probably heard of the SARM indicator, and again, we'll have a look at that in a moment, but it's certainly not signaling a recession or anywhere near at the moment. But as unemployment increases, it increases the nearness, if you like, of a weakening of the economy. And if it starts increasing rapidly enough, it's a very reliable indicator of US recession. But we're far from that at the moment, but it is edging up. So it's edged up to 4.4% in the latest print, the latest numbers. Now, what was interesting was that Powell was talking about the data and how in the US, obviously you can't literally go out and count the number of people who are working. It's all done via a survey. And it turns out that the surveys have been fairly systematically overestimating the number of people who are actually employed. And Powell's saying that it's overstated by about 60,000 jobs a month. So if that's the case, then it could be that we've actually got contraction in the labour market right now. So what we thought was, pretty good jobs print, or at least not negative, may in fact be negative. So he was saying it might be minus 20,000 a month. Now, that's not as bad as it used to be, because remember that if you have less people coming to the country, and immigration has plummeted under Trump by design because of illegal immigration, but also broader legal migration has fallen. Well, you need less jobs to be created if that's the case. So what we've got overall is a job market in which you've got less supply of workers, but less demand for workers at the same time. And the people who are in work, and we'll talk about AI in a second, but the people who are in work, employers tend to be holding on to those people. So let's talk about GDP projections. Those were upgraded to 1.7% for 2025 and 2.3% for 2026. Now, part of that was due to the shutdown. So Powell was saying that actually 0.2% of that you could actually move backwards in time, shuffle between the two periods because of the jobs shutdown. But what's interesting at the moment is there was a lot of discussion of AI in the press conference and the questions that happened after Powell made his statement. So there's been a huge amount of fixed investment in things like data centers and AI infrastructure. And there's no question that that's boosted US GDP. Some people have said that the US would actually be in recession if it weren't for those huge increases in infrastructure spend for AI. It's also had a big job effect. It's had a big effect on the US jobs market, particularly in productivity. So if you think about how productive someone is, if they're a knowledge worker, such as me, for example, I can be much more productive if I can get AI to do my research for me. And then I'm a kind of front guy for essentially what the AI has helped me research. Of course, you have to guide it. You have to know the prompts. You have to know what topics you want to cover. But if you want to do the research now, you don't have to hire an assistant to help you with that research. You can use AI for that. And that's made people more productive. So people have actually said to the Fed, they've got a big group of companies which they're in close contact with. Companies have actually said that AI is the reason why they've got hiring freezes. They just don't need the staff because AI can do their jobs. So what's weird is we've got this kind of jobless growth where GDP has been in pretty good shape and it's being upgraded. And yet at the same time, we haven't had a big increase in demand for workers. So maybe this is a part of a pattern of future jobless growth in the US, where AI makes the existing workers more productive, but it doesn't require more workers in order to create that increased output, which is interesting, I thought. there was also a big thing in this kind of press conference about plumbing. Now, for the bond market, the thing that nobody knows about or understands seemingly is reverse repo and repo markets, but they're actually critical for the bond market, and the Fed is part of that plumbing. Now, the Fed has actually shifted the way it controls interest rates massively since 2008. It's gone into what it calls an ample reserve policy. So remember that what the Fed did was massively increase the size of its balance sheet by buying US treasuries and mortgage-backed securities. So think about what that does to the economy. If the Fed buys a bond from someone, a treasury, well, it gets the bond, it puts it on its balance sheet, and it hands that owner of the treasury cash. So effectively what's happening is the Fed is injecting cash into the system. And that can be new cash, because remember, the Fed can create cash to buy that bond. So this is a money creation process. It's pumping liquidity, money into the system. And of course, when it goes into reverse quantitative tightening, then the opposite happens. You're actually sucking money out of the system. Now, the way you control interest rates varies according to whether you've got this ample reserve system. And what we've seen recently is that short-term interest rates have been really shooting up and looking unstable. So the Fed has now said that it's going to start buying bonds. So it's going to do a process called it's going to do a process where it actually does this buying of bonds in order to control interest rates, which is very different from the system we had until recently, where it really didn't have to do that at all. And Powell stressed that this is nothing to do with monetary policy. It's completely separate. So it's called reserve management. It's not quantitative easing. Although you could say, well, it was pretty similar. The Fed's buying bonds, but yeah. Anyway, that was a big point that Powell was talking about, and it is important because it's about how the Fed controls interest rates. So yeah, I think that is an important point. But anyway, Powell thinks this is not to do with the how restrictive monetary policy is. That was one of the things he stressed. So, where are we right now? Well, the Fed's back in wait and see mode because it's pretty close to a neutral rate now, and it's not on a preset course. It's no longer aggressively thinking about cutting interest rates. It's now much more of I'd say, an even decision about whether it should cut rates further. There was a question from Nick Timmerhouse of the Wall Street Journal who said, are we going to start thinking about rate increases now that it's kind of equal risks on the upside and the downside? Well, Powell said, no, nobody's talking about rate increases at the moment. But of course, that now becomes more likely, right? So previously we never would have thought about raising interest rates, but now it's becoming more of a possibility. It's certainly not priced into the market expectations, but it's now something that we might think about. So overall, the US economy is doing okay. Tariff-induced inflation doesn't look like it materialized, and certainly it's not sticky. We do see tariff-driven inflation in goods, but how long that lasts doesn't look like it's going to be sticky. And AI-driven productivity has pretty much saved the US economy because there's a huge amount of spending on infrastructure. There's been an increase in productivity as a result of AI use by companies, but it has produced a system where we've got jobless growth. So, it would be nice if it created jobs, but that process seems to be a lot slower than the actual process of not hiring new people because AI can do existing jobs. But at least what we can say is that this era of aggressive tightening is kind of long gone, right? We're now in an era where we've got fine-tuning of monetary policy. So let's just look at some of the numbers now before I hand it over to you for the questions. And then I'll hand it over to you. And I'll also summon my cockapoo for some schnacks. I've got his burgers ready. Right, here we go. Yeah, so obviously Powell's not going to be around forever. He's going to leave the job in May of next year. So there were some questions about that, and he was quite cagey about what he wanted. And essentially he said, look, I just want to leave the job. Whoever takes over my job, I want to hand over an economy that's in good shape, without high inflation, with reasonable growth. So he was quite nice about it, as you'd expect. What was kind of interesting is if you look at the last three announcements from the Fed, so this is the press release that they announce half an hour before the press conference, every single time Stephen Moran, who, remember, still has one foot in the White House, he's temporarily given up that job in the White House. He's one of the economic advisors, but now he's in the Fed and he's voting. Every single time he was the outlier. He was the one that wanted to cut interest rates by half a percentage point, when everyone else either wanted to cut by 25 basis points, or actually wanted to raise interest rates. So, or no interest rate change, right? But anyway, yeah, pretty clear that his read on the economy is way out of whack with the rest of the members of the committee. So who is expected to be the next Fed chair? That's also kind of interesting. And I always like going to these betting markets to have a look at what people are forecasting. And currently it's going to be Kevin Hassett, which Kevin Hassett is not the favoured market. He's not the market favoured appointee, because many people expect that he will bow to the will of Trump and have a very dovish or a propensity to cut interest rates, even if that's not appropriate for the economy, even if it's inflationary. He will bow to Trump's will in order to cut interest rates, even if it's not appropriate. So he's not seen as the one which markets would like. More market friendly would be the other two choices here, which would be Kevin Warsh or Christopher Waller, both of whom probably more experienced and market friendly. But certainly at the moment, betting markets expect that Kevin Hassett is the shoe-in. If we look at policy, you can see that previously, last time I did this, the US was above the UK. Now it's kind of leapfrog below the UK, and it's probably going to be here for a while. At least that's what markets expect. And it's still pretty much at the top of the pack. The euro area is well below at 2% for its policy rate, as is Canada, as is Australia, and then the US is kind of sandwiched between the US, between Australia and the UK right now. And there wasn't much change in the language of the statement itself. You can see that there is a comment here about those reserve balances and talking about ample levels and how they're going to start buying shorter term treasuries in order to maintain this ample supply of reserves. So there was a bit of discussion of that there. And if we look at the summary of economic projections, which has been updated for this meeting, so this is the dot plots, I think the table's quite useful to see what's going on. It's pretty clear that there's been an upgrade of GDP. So compared to the September forecast, this year's GDP has been raised slightly, as has next year significantly. But remember that point about the cut, about the shutdown in the US. He was saying that probably 0.2% of growth should be moved back from 2026 to 2025. So this would actually be 1.9. And then this 2026 estimate would go to 2.1. So not as extreme as you might think. But still, upgrades on GDP, that's good. Unemployment, pretty much the same. PC inflation, pretty much the same, maybe a little bit lower. Core PC inflation is pretty much the same as it was, a little bit lower. So not a hugely different, but yeah, these are the dot plots as we see them now. And the one which everyone's interested in is what the members of the committee expect for interest rates. After all, these are the people who actually set the interest rates, And each of these dots is one voting member of the committee, what they expect right now. And you can see that we are pretty close to the long run average now. So long run average, the median is 3. Currently we're at 3.6, but by next year they're expecting we're going to get to 3.4, and then by 2027 we're pretty much done. You know, we're almost at the end of the cycle. And that's just my guess, by the way, that this was Steve Moran's dot. It was this one, the one which is far lower than everyone else. It really is an outlier. Anyway, come back onto the expectations. So this is what it looked like. You know, I do this every time I have one of these live streams. Before the meeting happens, I look at these probabilities. So the rows here are individual meeting dates. So this was as it was on September the 17th. Markets expected that the rate would be cut by 25 basis points. It was. Then in October, that's the previous one, they expected another cut to between 375 to 400 basis points, and it happened. And the dashed line you can now see is when Fed Chair Powell is going to leave. So whoever takes over is going to be doing the rate decisions after that. And you can see by that point, markets were pretty much expecting that rates would be constant after Powell left. And that's pretty much the situation now. So the situation was they were expecting a 90% probability of a cut today. That's what happened. The next cut they're expecting after Powell leaves. So over Powell's remaining tenure, which is until the April 29 meeting, the Fed's not going to move. And then after that, whoever takes over is going to do the first cut, maybe one more cut, and that's it. We're done. So that'll take us down to the long run average, remember. The balance sheet, this is the important bit because this is about the plumbing. They were talking about stopping QT, but now we've got this kind of problem with reserves. They're going to have to start doing the purchases of short-term treasuries, which will pump liquidity into the system and create reserves. So they're not moving away from the ample reserve policy, far from it. They're trying to make sure that the reserves are ample. And of course, we've got the tax date coming up on April the 15th, when lots of people pay their taxes. That tends to drain reserves. So they're just making doubly sure that we've got lots of reserves in the system in preparation for that. There was something interesting here which I wanted to show you. This is the SARM rule that I was talking about. Now the top panel is the critical number that Claudia Sarm discovered. So what she did was she looked at this 3-month average of the unemployment rate in the US and subtracted the minimum of the average over the last 12 months. And that creates this kind of almost like a heart monitor. It looks like one of those ECGs, but this is the kind of pulse of US recessions, if you like. And whenever that unemployment rate starts to surge upwards, that difference between the average over the last 3 months of the unemployment rate and the minimum over the last 12 months surges upwards. And when it crosses this dash red line, that signals the US economy going into recession. There was a false signal in 2020 with the pandemic, but you can see for every single recession before that, going way back before 1960, it was an uncannily good measure and a real-time measure of US recession. So this really is a good one to watch. Now notice, I don't know if you can see it, but this is starting to increase a little bit. There's just a little inflection up towards the dash red line. We're not quite, nothing worrying yet by any means, but it is something to keep an eye on. Inflation coming down. This is the payrolls number. Fortunately, we're not going to have to fire anyone else at the statistics agency again, because the numbers did seem to pick up in the latest print. But as Powell said, this might be overstating the number of jobs which are created. So this is non-farm payrolls, of course. So this is the number of jobs which are added to the US economy month by month. And now that we've got less immigrants, you're not going to have so many new jobs to absorb new entrants to the jobs market. So the kind of stable level of that is now lower than it was previously when we had higher US immigration. So that kind of summarizes the state of the economy, my take on what's going on. And at this point, I'll summon my cockapoo and ask you to like and subscribe. because that helps our channel a great deal if you do. And yeah, and that way you won't miss any of our new content. Incidentally, somebody in my community called me a fun sponge. So one of my Christmas presents, birthday presents, because it was my birthday 2 days ago, one of my birthday presents was this. Look, I'm an official fun sponge. It's great. So Laura said I could have this on my shelf on the live streams, but I can't have it on my shelf during a video. So if it appears on the shelf during a video, my video editor did manage to edit it out. Brilliant. So here we go, Ted. I have one of these burgers. He doesn't have more than one of these. He has one of these every morning, and I feed it to him bit by bit because otherwise he gobbles it and then chokes on it. There we go. Good boy. You're going to stand for me. Why don't you stand up? You get off my leg. That's it. Stand. Good boy. Good boy. He's still using my leg. There we go. Good boy. Good boy. You're going to go downstairs for biltong now. Go back to Laura. Good boy. There he goes. Brilliant. So yes, think of a question, and ideally one about investment or the Fed, monetary policy. Oh dear, screen. How do I switch this back on? Is that working? Possibly. Right. Yeah. So anyway, do think of a question. If you are one of our supporters on YouTube, then we will push your question to the front of the queue. And if you do a super chat, we'll push your question to the front of the queue. So please do a super chat. Obviously, that helps us financially. Let me move this over to the left. Bit of screen management here, which hopefully you can't see yet. Summary of economic projections. Okay. Yeah, so please do ask a question. Please do super chat, and I will attempt to answer your question as best I can. Have we got any more windows I've got to move together over on the right? No. Okay, great. So yeah, any kind of questions you've got, please do ask, and I will try to answer. It's funny because I thought Powell did quite a good job tonight. I thought, Trump always says he's an awful communicator. I think he's pretty good. I like Powell. I'll miss him when he's gone. I just can't imagine Kevin Hassett as the Fed chair. So tell us what you think in the comments. Who do you think should be? Maybe we should do a poll. Yeah. Poor Sam. Sam Hale is our community manager, and she's handling the live stream comments tonight. So poor Sam. So she's having to kind of do this. But maybe we could have a poll, Sam, to see who people think should be the next Fed chair. So what I'll do is I'll tell you in the document, Sam, which ones are potentially in the running, and then maybe what you could do is turn that into a poll. So what I'm going to do is I'm going to get the runners in the potential people who might be Fed chair, and then you could maybe add them to do one of those polls on YouTube. And unfortunately, it has to have some kind of time limit, I think. So you have to have a decision before the time limit ends. So let me see if I can find that document. 1 second. And then we can see. Yeah, here we go. So this was... Let me share my screen so you can see this. These are the people who are in the running. So Kevin Hassett is one of them. Kevin Walsh is another. and Christopher Waller. Whoops. Christopher Waller's another. So let me just chat these over to Sam, and then she can make the survey. Brilliant. Yeah, so who do you think should be Fed chair? And if it helps, what I'll do is, yeah, oh, there we go. So she's got the list. What I'll do is I'll also share a thread which I did on Blue Sky, which might help you, which maybe Sam could share as well. Actually, I could do that, couldn't I? I could put it onto the YouTube. YouTube app. Or maybe not. I think I've lost the ability to see the actual questions on YouTube, but yeah. But anyway, let me find the actual Blue Sky thread, and that might help you. Is my point, because it kind of goes through the choices which are out there and suggests some of them, and a little bit of background on each one. So if Sam could take that Blue Sky thread and just post it onto the comments on YouTube, that would be great. So I now cannot see what's going on, or can I? Yes, I can. I'm back. Okay. So if I, yeah, there we go. Thank you, Sam. What a star. Sam is so good. Thank you, Sam. She is an absolute star. She does a great job with the community. You know, if you join our community, she's the friendly face, well, the friendly chat, which ensures that you can sign up correctly. And if there's a problem, you know, she sorts it out really quickly, as does Laura, to be fair. But Sam is increasingly taking over that role. So thank you, Sam. Brilliant. So back to your questions. And I see we do have some super chats already. So let's get started. Make that bigger. There we go. So first one is from Johnny B 2005. Thank you for your question, your super chat. And oh no, actually this is one of our supporters on YouTube. Hi Romin, 100k for a made up digital currency with no real legal use. Why is this just accepted? Are we all crazy? Well, I think calling it a currency is a mistake. I think it's just difficult to classify. What is Bitcoin? Is it a currency? Is it the store of value? The narrative is always changing. I think what's pretty clear is that its value is going to be around for as long as there's enough community members, investors who kind of believe in it. So in that sense, you know, it's like gold. You know, the value of gold is purely driven by what people are willing to pay for it. It provides very little economic value. The good thing about it is you can store it. It's fairly fungible. You know, one bar of gold is just like another if it's very pure. It doesn't tarnish. It's very dense and easily portable. I did have a go at lifting the one in the Bank of England, and it is very dense. I can confirm that. If you go to the Bank of England Museum, it's really amazing. You can put your hand in this perspex box and actually lift the bar of gold which is stored in there. Unfortunately, you can't lift it out as I confirmed. But yeah, so gold is kind of similar. You can see why it's described. Bitcoin is described as digital gold. It doesn't generate cash flows. You can't work out a fundamental price for it as a result of that. So it has no fundamental value. It doesn't generate anything useful. So it is a purely speculative investment. So how does it behave? I think that's the way to understand it, is how it behaves if you look at the price. What is it correlated with? Is it correlated with gold? No. Is it correlated with equity? Yes. Which equities? Primarily the Nasdaq. If you take the Nasdaq, multiply the daily return by 3, that's pretty close to the behavior of Bitcoin. So what does that tell you? Well, it tells you that it's a risky asset. It's not a safe asset. It's not a safe haven asset. When equity markets sell off, when risky assets sell off, it sells off. Therefore, it's a risky asset. Is it something that's going to diversify your global index fund? No, because it is highly correlated with the equity market, particularly the Nasdaq. So what is it? Well, maybe you could say that it's there to keep governments under control, so that if your country's currency fails, it provides a way of preserving your wealth outside your country's currency, which is true. But if you live in a developed market, that's seldom a concern. If you live in a country which is a failed state, well, yeah, then it is a concern. So maybe it's useful in that kind of edge case. But for most people, I just don't think you need it. I mean, that's not to say I don't buy it. I do. I kind of play around with it. And I've recently bought it in the form of Wisdom Tree's ETN, WXBT, I think the ticker is. But that's part of my fund portfolio where I do all of my kind of speculative stuff. What was the ticker? WXBT, yeah. And the Ethereum one's WETP, which has kind of staking as well. But obviously the Bitcoin one doesn't have staking. But the fee's fairly low. It's liquid. I can buy and sell it easily on my investment platform. I don't have to fiddle about with cold wallets or any of that. It just sits there in my portfolio like it should. Well, I don't want to know all the kind of libertarian nonsense around it. I just want to know the return. How much are you worth today? Are you correlated with the rest of my stuff? That's it. I don't want to have a big headache, which I don't have with my other investments. So now it does that, right? It fulfills that well-behaved part of my investments. A very volatile part of my investments, but yeah, it doesn't need any special treatment, which I think is a big step forward. And I can trade it on a regulated exchange. I don't have to go to these dodgy cryptocurrency platforms any longer, which is a big step forward. But the thing is, as it gets more mainstream and the volatility falls, its return also falls, because risk and return are related. So expecting the crazy returns we had in the past alongside lower volatility is just unrealistic. I think its returns will be lower in future. So that was one of the drawbacks of success for Bitcoin, and also becoming more acceptable to institutional investors. Anyway, why is it accepted? Because there are enough people who believe in it. I think it's as simple as that. Are we all crazy? Of course we are. We wouldn't be sitting here listening to me talking about the Fed, I guess. Next question is from Epic Chess 2021, and this is a super chat, so thank you for your super chat. And you say REITs suck for years now. I'm in XDER. Any thoughts on when we see turnaround? Thanks. So let's have a look at that REIT because that could be interesting. XDER is not one I'm familiar with. But let's explain what a REIT is first of all. So it's a real estate investment trust. And they come in various flavors. So just like equity has sectors, so does the REIT universe. So these are, they trade like stocks on an exchange. They are tax efficient in the sense that if they give out a certain amount of their rental income, which is generated by their investments, to their investors, the people who own the shares of the REIT, then they're classified as a REIT and they get certain tax breaks, which means they don't have to pay corporation tax on that income, I believe. So from the point of view of the owner, it's a very tax efficient structure for owning commercial real estate. But it's not just commercial real estate. You can have things like data centers. That's a big growth area, of course, at the moment. You can fund that via a REIT. You can have all sorts of things, land for telephone masts. If you've got a 5G mast, the land on which it sits, the infrastructure around that could be funded via a REIT. They come in all sorts of, loads of infrastructure projects can be funded with a REIT. So everyone is different. So it's always important to look at the actual portfolio for the individual REIT. So let's do that for the one you mentioned. So this is the FTSE Europe real estate REIT. And if we look at the actual sectors, that's always interesting too. So for example, is it lots of office space? Because if it is, office space isn't so much required now post-COVID. So that would be a worry. So it's always worthwhile looking at that sector breakdown. So let's have a look at it for this one. Top sectors are real estate services. Clearly this doesn't add up to 100. Industrial, retail, diversified. So office is only about 17% of it, which is reassuring. 16% of it, which is reassuring. Development is when you buy property, do it up, and then sell it. So, or build on maybe a brownfield site, for example. So that would be REITs for development. And then we've got residential REITs and kind of specialty REITs in there. So it's fairly broad in terms of the sectors which it operates in. About a fifth of it is in the UK, about a fifth in Germany, some Sweden, France, Switzerland. Let's have a look at the description of the fund, because that's usually interesting as well. The aim is for your investment to reflect the performance of this particular index. Now, the FTSE, EPRA, REIT indices, there are indices for all the different subsectors of REITs. They often track one of these REIT, EPRA REIT indices, and this is one which is specifically for Europe. So certain property companies, including real estate investment trusts. So it's not just REITs by the sound of it, but they have to be listed in European developed countries, which of course includes the UK. So now let's look at the price of it. Also look at the charge. So 0.33, not egregiously high. It has a fair old chunk of assets, just under $1 billion, so 674 million. And it's an accumulation fund, and it's seen as a value fund, which is also interesting. So let's have a look at the price action. So it hasn't been great. Let's overlay global equity just for comparison. So MSCI World, which is a developed market index. And yeah, you can see that it's massively underperformed global equity pretty much since that 2020 sell-off for COVID. So equity markets bounced back really quickly after that, but you can see that this fund didn't. And in fact, it turned south after that as interest rates increased. Often it's a very interest rate sensitive sector. And if interest rates are high, then it becomes more expensive to fund that real estate. So it's often a negative factor with higher interest rates. And it hasn't really recovered much at all. So let's try charting the total return if we can. That brings it up a bit, but still not great. Yeah, so I'm not that impressed, I've got to say, with the returns. But look, the time to buy these things is when you expect interest rates to fall, you expect economic growth because they're very cyclical. So if you're kind of contrarian and you think growth in Europe is going to be better than expected, this might be a sector to consider. But as I say, make sure you understand the sector composition of the REIT and that it is going to benefit from a cyclical uptick. And that it doesn't have these structural problems. Like if it had lots of office REITs inside it, that would worry me. But this one looks okay. But you'd have to read the prospectus and then have a stab at whether the new economic environment is going to be one which favours that REIT. That's the way I'd probably approach it. But yeah, I mean, interest rates were the biggie, right? That was the thing that really made it sell off. Next person is Anthony Bevington, who says, "Hi Roman," it's a super chat, thank you Anthony. "Do you know why value stocks have done so well this year? I have a small value tilt, so not complaining, but unsure of the reasons. Thanks." Well, I think one of the reasons was the fact that interest rates obviously were not falling as fast as people expected. Remember that low interest rates favour growth rather than value. And it looked like rates were coming down more slowly than expected. So I think that was certainly a factor. I think value was massively undervalued relative to growth. So if you look at the difference between the two, value and growth stocks, and I wonder if I can find it. You know, I always think, oh, I'll show them that graph. And then I end up kind of scrabbling around on the Yardeni website for a while. So just talk amongst yourselves while I dig out that graph, hopefully. And what I'm looking for here is hopefully going to be to do with the different parts of the US market. So hopefully this is going to compare value and growth, or is it? No, it's not. I'm here looking at the Yardeni website, which is brilliant, by the way, for graphs, if you can find them, which sadly I can't. Is it there? But they had this beautiful graph, which I used for a long time, which showed you the average valuation for value stocks in the US versus the average valuation for growth stocks. Now, of course, growth stocks are going to be valued more highly than value, but the difference between the two varies a lot over time. If growth becomes really popular, as it did, then it becomes much more expensive relative to value. And if nobody wants to buy value, then you know that discrepancy increases. Can I find it? No, I can't. Okay, now that would be useful if AI could do that. If I could, in the middle of a live stream, say, find me this graph, and it would just pop up on the screen. That would be great. You know, maybe you can do that. I don't know. Value. So let me share my screen just so you can see me scrolling around here. So it doesn't seem like I'm just playing with my mouse in the background. Is this? This is World MSCI. This is by country. Eurozone. No. Okay, that's not going to work. Anyway, but I think that discrepancy was so extreme that growth kind of fizzled out. And of course, the narrative around AI shifted quite shockingly when we had the DeepSeek model, which came to market, and suddenly we saw that you don't actually need such computationally intensive calculations in order to achieve what was a very good model that could compete with things like ChatGPT. So that certainly dented confidence in the ability of the US to really dominate the AI world. But then, of course, we got the clampdowns on exports of really fast chips by NVIDIA, created by NVIDIA, to China. Now that's been eased. We've seen that over the last few weeks. So, you know, that's the pendulum that keeps switching back and forth. But growth, the narrative about AI slowing down, maybe overspending, you know, that definitely took a dent out of growth, and value came to the fore. But again, it seems as if value has kind of shot forward again now. But like you know, I had a tilt to the UK, which was a big value market. That's the other point as well, of course, which is that Europe, for example, defence spending in Europe was going to increase massively. So if you look at the European stock market, the UK stock market, both of those had a big surge, partly led by defence companies. So that was a large part of the reason behind the surge in Europe. In the UK, we've got lots of miners, lots of gold miners. The copper price surged, the gold price surged, the silver prices surged massively. So miners are going to do well out of that. So by not having tech, it was actually in the UK's favour and Europe's favour. But now it seems as if we're back on the kind of bandwagon of AI is going to rule the world. And yes, the spending is all going to be justified. You know, that seems to be what's happening. As that narrative switches on and off, you get growth surging or kind of pulling back, and then value taking its place. But personally, you know, I think, you know, I probably would stick with the value approach. If you believe in it, you've seen now that it can actually do okay after a period when it didn't for so long. So, you know, maybe stick with it if you believe in the factor. But I think those are the reasons behind it. Next question, another super chat, is from WickerBill173, who says, not Fed related, but CSH2 versus bonds. So CSH2 is a money market fund. Lots of recent issues of money market funds. And I know this because on PensionCraft, we have a list of cheapest funds. And the members tell me, oh, Roman, look, we've got a new fund, so put it on your list. So I do. You know, I'm very, very loyal to my community like that. I do as they say. And it's obviously to everyone's benefit for us all to kind of keep track with what's going on. So if I pull up the money market category, I've got a couple of new entrants recently. Previously, the only ETF ones were XSTR, I think, and CSH2. But recently we've had a couple of new ones, one of which has the ticker GONS. And there was another one which we learnt about today, which I added to the table today. Money market, here we go. So these are all kind of cheap funds. It's by no means an exhaustive list of funds. These are just cheap ones within each category, and got a bunch of categories and a bunch of regions. But this is money market funds. HGBP was the new one. It's an accumulation one. It's sterling denominated. It's one of these transparent ones where you can drill into it and see what's in it, which I love. So let's have a look at what's in this one. And it's got the pie chart. We know the duration of the investments. We know what the investments are. We know it's benchmarked to SONIA, as it should be, the Sterling Overnight Index Average Rate. Has it got the portfolio? I think it does. And here it is. So you can actually see what's in there. You know, the rating of all the paper. You can see its breakdown by, you know, the type. So commercial paper makes up about a third. Certificates of deposit makes up about a fifth. Deposits about an eighth. CDs, floating rate CDs make up, certificates of deposit make up 9.2. Floating rate notes, repo, and so on. So you can actually see what's in it. Tiny bit of government debt actually, which is interesting. But the maturity, ultra short, just as you'd expect with a money market fund. And that's what you want to see, right? 1 to 3 months is long duration for these kind of things. Quite a bit of it is 1 week in maturity, you know, so almost zero duration, very short duration, almost no sensitivity to interest rates. All that happens is the rate of growth will increase or decrease according to the rate of SONIA. So very low volatility. So, you know, transparent, low fee, I like it. And the other one was GONS. So that one's from Invesco. So ticker GONS, that was the other new one. But your question is about gilts and about how they compare with a money market fund like CSH2. Because all of those money market funds you just saw, if you plot the accumulation ones versus one another, they'll be very similar. Very low volatility, just trundle upwards at the SONIA rate. So if you annualize the rate of return, if you extrapolate the line over a year, it'll be roughly SONIA, which is currently just under 4%. So how does that compare with gilt is, I believe, your question. Let me just double check that was the question. I got burned badly in the big bond drop a couple of years ago, so nervous about long-term bonds. So what you want is almost no duration. So money market funds offer you that. So let's have a look at another alternative. The other thing you can do is you can buy single gilts. If you're worried about mark-to-market losses, if you buy a gilt, you know precisely what you're going to get. So if you hold them to maturity, you never have to worry about losses because the government won't default on its debt. That's exceptionally unlikely in the UK because it can print money, remember. They still have sovereignty over issuance of UK money. Not true of all countries, of course. But if we have a look at the gilt cash flows, let's choose a gilt just to get a feeling for what you get. So let's choose a 5-year one. So it's currently 2025, so 2030 would be a 5-year gilt. Let's just choose one of these three. 3 of them. Let's choose the one with the highest coupon, TR30. So this is what you get, right? So let's say you want to buy 10,000, a slug of 10,000 worth of UK debt. So this is money which is going to get paid back to you from the government, and you're going to get paid back £10,000 worth. All of the coupons that you get paid are a percentage of that face value, and on the maturity date you get paid back that 10,000. So 10,000 multiplied by 4.75%, chopped in two because it's every 6 months, means each of these coupons is £237.50. And then how much would you pay for that today? You'd pay 10,370, and the future total cash flows would be 12,375. Now if you annualize that rate of return, it comes out at about 3.9%. So that's it, right? The day you buy the bond, you know the rate of return almost exactly, not quite exactly, because you have to worry about reinvesting these coupons. But if you could reinvest the coupons back at that yield rate, this is what you'd earn, right? So that's the yield to maturity. So just under 4% at the moment. Let's go back to the yield curve. The question you're asking yourself is, remember that this money market rate is the dashed line here. That's going to fall as the Bank of England cuts interest rates. Whereas if you bought that 5-year bond, you'd be locking in with, what was it, TR30, was it? T30? You'd have been locking in that rate of return. Was it TR30? Yes, here we go, TR30. So you'd have been locking in that rate of return for certain. So if you don't care if the Bank of England cuts interest rates, if you've bought the gilt. If you own the money market fund, you bet you care, because they could cut it to 3% or 2% even if there's another crisis, or 0. So that's the difficulty with CSH2. The rate of return is variable. It's based on monetary policy, which is based on what the Bank of England does, which is based on the view of the Bank of England about the UK economy and the global economy and all sorts of other things. So I think the certainty is what you get with the gilt, which you don't get with CSH2. And as we are in this kind of rate cutting environment for the Fed, but also for the Bank of England, this rate will almost certainly fall, and that makes the gilts more attractive. So you won't have to go so far out on the yield curve to have a yield which is higher than what you get with the money market fund. Of course, these things are dynamic; they change day to day. I update this graph every day, but those are the considerations. Do you want certainty with a gilt, or do you want uncertainty but a currently fairly competitive rate with a money market fund and easier management, right? A lot of people have difficulty with gilts because they don't understand them or they're scared of them. And they are complex, they're a bit more complex than just buying a fund. Not all platforms have them, although increasingly platforms do, because I think they've realized that investors like them. And of course, they're very tax efficient, because if you own a gilt, you don't pay capital gains tax on it if it's held outside an ISA or a SIP. So by choosing those low coupon gilts, you get a very tax efficient investment, which is very low risk. So I think that's the kind of differences between the two. But would I buy long duration bonds? No, I probably wouldn't, because I buy bonds for safety, and maybe as dry powder, and maybe for cash flow planning. Johnny B 2005, a member of our community, says, if it's accepted that you can't beat the market, why do banks and funds employ so many quants and analysts? What are they all doing? That's a great question. Yeah, I mean, I knew quite a few of them, and I was one of the analysts myself. So, of course, the quants and analysts wouldn't question their existence. Of course they wouldn't. But primarily, they're to allow banks to market their products and to create their products for clients. So let's say you want, you've got a trading desk and you want to work out how to price an option. Well, that product can then be sold to clients, but only if you price it right. And so the quant would be the person who actually works out what the price of the option should be. Now, it sounds complex, but really all they're doing is working out the hedging cost. That's how you price options. How much does it cost me to hedge it, to create the option? I'll add a bit of bid offer spread, and that's it. But obviously it's more complex than that for really complicated, barrier options or really complex stuff. And fixed income options are usually more complex as well. But that's the gist of it. What's the hedging cost? Add a bit off the spread, and that's your price. But that's what the quants do. They're the people you turn to when you say, look, the clients asked for this. What price should I offer them? So that's what the quants do. So for more complex products, which of course are the ones which offer more fees for the banks, the quants produce the products and they price the products. And the structurers are the ones who are a bit more creative, who create the products which have maybe multiple options built into them, maybe even fixed income products bound together with the options. So structurers are the kind of almost like a kind of business analyst, which would look at what the clients want and then find a structure which meets those goals. So let's say we've got a country where capital gains is very high, whereas income tax isn't. Well, you create a structure which converts one form of gain into the other one, which is more tax efficient. So that might be one structure. But they're really creative when they come up with financial stuff. So they often cause the bank to blow up, but we won't talk about that. But yeah, so that's what the quants and structurers do. And the analysts, it's their job essentially to market the products for the bank. They won't say this. They won't say I'm part of the marketing department. Of course not. They think of themselves as doing research to help the bank's clients. But in fact, the bank assumes that if they publish research which is valued by their clients, who are usually pension funds, hedge funds, insurance companies, sovereign wealth funds, if they give them research which is kind of cool, and they go and visit the client in their office with that guy, like a kind of performing monkey, and they kind of say their thing, and they can ask questions and meet them face to face. If they've got the star analysts, well, that bank hopefully will get more business from that client, because they know that if they don't have business with that client, then they're going to cut off that research. So that's essentially what it is. The research is a sweetener which hopefully generates revenue for the bank. So the question then becomes, does that research increase the return of the funds which receive the research? And the question there is, well, the answer there is almost certainly no. So I'd say, this is an industry which certainly the analysts don't probably generate any alpha. Maybe they've got good research, they've got good analysis, but if they did produce analysis which was accurately going to forecast whether company A would do better than company B, well, if that was the case, then presumably that would generate alpha for the clients which receive the research. But that's not what we see. Just look at the S&P index versus active report. You'll see that actively managed funds don't usually outperform in aggregate. Maybe that's because they all get the same research, so there's no informational content which allows them to beat their competitor. But it is the case that not all banks receive all research. So, I think that if it did have an edge, then you'd see it in the numbers. But I'm not convinced. So I'd say it's just a hangover of the era in which people thought that fund managers, active fund managers, could beat the market consistently net of fees. And we'll see, I expect we'd see these analyst numbers shrink as people buy more passive funds. There are less active funds, and the value of those active funds business for investment banks starts to shrink. So I think they've just got to find new lines of business. But anyway, that's my take on it. And I did work in the industry. But it's taking a long time, I've got to say. There are still so many analysts that people still pay attention to, which is odd. Nice to see you, Amir Ketobchi, who has a question, one of the super chats. Thank you very much. Very generous super chat. Thank you, Amir. He says, Merry Christmas to all at PensionCraft. So that's me, Teddy, Laura, Sam, and Michael, who does our who co-hosts the podcast. Thank you very much, Amir. Give us your top 3 considered predictions for 2026. Ooh, tricky one. Oh, we did the survey, didn't we? Before we go on to Amir's question, let me just have a look, see if we've got the survey. So Sam, hopefully. Yes, here we go. Who should be the next Fed chair? And oh, it's a tie. Kevin Hassett is tied at 39% with Christopher Waller at 39%. So that's interesting. You know, you don't agree with the Kalshi market prediction, so you think that actually Waller's in with a chance. That's interesting. Yeah, because Waller would be a kind of more market-friendly choice. Yeah, but you know he's already a current Fed governor, so he would offer that kind of continuity. So that would be interesting. But interesting choice. I think I'll probably add that to the thread on Blue Sky because that's really interesting. Anyway, coming back to Amir. So predictions for next year. Okay, so let me make something controversial. I think the value is going to outperform. This is it. This is the year of value outperformance. And you can hold me to this, right? Because Amir, you always show up at these live streams. So next year, I think value will have outperformed growth. I think the UK will have performed well. So that's my second guess. Because I think people are just far too bearish on the UK's prospect. Actually, the UK is actually pretty well positioned in some ways. You know, we've got a lot of good services companies in the UK, which presumably could benefit if they start to use AI. So if we become more productive, given that we've got a knowledge-based economy, and if we use AI effectively, I think that could really increase UK productivity, and nobody's expecting that. You know, they just think we're a basket case where we're kind of has-been, where we kind of shot ourselves in the foot with Brexit. I don't buy that at all. I see a country which is got a great educational system, very creative. You know, in the creative industries, we really do dominate and punch above our weight for movies, for music. And also intellectually, you know, for things like academic research. So I think the shock's going to be a bump up in UK productivity due to AI, and perhaps, you know, we outperform it on the stock market because UK stocks are ridiculously cheap. So that's my second prediction. My third one is that precious metals are going to collapse. Because if you look at the price of precious metals right now, and if you look at the valuations, they are absolutely bonkers. So let's have a quick look at the PensionCraft trackers for that. So we've got a really simple model which looks at CPI inflation, real interest rates, and the value of the dollar, the trade-weighted value of the dollar. Factoring those three things in, the price of gold should be 35% below where it is now. So I think that's going to snap back to the model, or at least to much lower levels. And then silver is even more crazy. So that's currently overvalued by almost 70%. Now, I did a video about silver, and it's got its own weird dynamic because you can't increase the supply of silver because it's a byproduct of other mining. So even if there's a big demand for it, the supply can't increase. So it tends to hugely overreact to supply and demand fluctuations. So yeah, that's gone mental. So that's my third prediction, that it's going to tank, the price of silver in particular. But you know, I don't know what I'm talking about. I'd admit that I don't know. So I never make forecasts for that reason, right? Because I've got no idea what's going to happen to markets. All you can really do is kind of have this kind of core approach where you've got a good allocation to equity, maybe diversify it into other asset types, keep it simple, keep your fees low, and stick with that allocation. So this kind of thing would go in my fund portfolio, which is the 10% where I play. So, you know, I could go short silver, I can do long short trades. I've got Scottish Mortgage, my UK small cap portfolio, which combines three factors: quality, value, momentum. I've got my copper miners portfolio, which is also doing really well at the moment because of the squeeze on copper. And the UK portfolio is doing surprisingly well because of the gold miners. So anyway, those are my predictions, and you can hold me to account, Amir. Anyway, that's it. So how are we doing for time? We've got 4 minutes and no more super chats. So I will go to YouTube and fish out one more question and choose very carefully. So no more super chats, please. Otherwise, I'm not going to see them. Let's choose one close to the bottom of the list. Oh, that's interesting. Wicker Bill 173, who I think asked a question about REITs, says, just keep an eye on construction, Romin. I work in the sector and there's been a massive downturn this month. First half of 2026 doesn't look rosy with planning and funding delays. That's interesting. Gosh, I learn all sorts of things from clients and also from these live streams. Thank you for that, Wicker Bill. The Fed is done. So what about the BOJ now? Oh, that's interesting. What's your take on that one? End of the world on the morning of the 20th. There's a good point there, which is that, of course, the Japanese pension funds like GPIF have a huge amount of assets. So if they pull money out of bond markets globally, because let's say that the Bank of Japan raises interest rates aggressively now because it's finally got inflation, it's been hinting it will, and it does. Well, if interest rates increase in Japan, that means that a lot of that money is going to be repatriated back to Japan, so that the Japanese pension funds can buy Japanese government bonds. That means they'll be selling bonds in the UK, the US, Europe. That means that they'll be selling the currencies in those countries. So the yen will appreciate, those other currencies will depreciate, and the value of their bonds will fall in the UK, US and Europe. Yields will go up in the UK, US and Europe. So I wouldn't underestimate the importance of this monetary policy decision. It's a reversal of decades of ultra low interest rates in Japan. So yeah, I think it will be seismic. Maybe I should talk about it. Maybe we should do a BOJ live stream. I'll talk about it with Laura. But yeah, this is a big one to watch. So do keep your eye on that. Yeah, interesting. But of course, I don't speak Japanese, and that would make things a bit tricky. We would rely very heavily on AI for that one. But certainly watch the outcome. Yeah, I think that's really important and a very good point. So thank you for that suggestion. What else have we got? Here's a good one to end on. Simple. Matthew Wogley 737. He says, can you hold individual gilts inside an ISA? Yes. You can hold them in an ISA. You can hold them in a SIP. You can hold them outside an ISA or a SIP. Not all platforms have them. Oh, very good. Boz47 says, Sonia's a nice lass. God bless her. Very good. But yeah, you can hold gilts in any of those accounts. Some platforms have them, some don't. I buy mine on Interactive Investor. More platforms are carrying them now because of the demand from investors. Other platforms have them. iWeb has them. Hargreaves Lansdown has them from memory. Who else has them? AJ Bell has them. Those are the ones I can think of off the top of my head. I chose II for them, Interactive Investor, because the trading costs were quite low. But yeah, lots of platforms have them. iWeb also is another cheap platform for holding them and buying them. Anyway, yeah, the answer to your question is yes. So brilliant. Thank you all for watching. And remember that I'll be doing this again for the Bank of England. So that'll be pretty close to Christmas from memory. Yes, 6 o'clock, 18th of December. I will be here in this top with my Fun Sponge sign and my elephant covering the Bank of England. And yeah, 6 o'clock, 18th of December. If you did enjoy this, like and subscribe. Why not subscribe to me on Blue Sky? Because that's where I make these ridiculous comments about things I'm angry about generally. So do look at that. Our community, pensioncraft.com/membership, if you want to join our community and ask questions, get access to those trackers you saw. And of course, our podcast is free. Many happy returns. A lot of people tell me they like listening to that. Largely thanks to my podcast co-host, Michael Pugh, who's wonderful. Yeah, thank you for joining us and good luck with your portfolios.